combination of contracts. An entity shall combine two or more contracts entered at or near the same time with the same customer and account for the contract as a single contract if one or more of the following criteria are met. The contracts are negotiated as a package with a single commercial objective. That means what? 2-3 contracts are taken together and they are negotiated as a package. It's a single arrangement because it's a single commercial objective. You buy a car with servicing facilities, 2 contracts are. You can buy a computer with servicing facilities. You go to a departmental store, you will see combo sales. 3-4 things are sold together. The amount of consideration to be paid in one contract depends on the price or performance of the other contract. You know very well, you go to a shop, if you buy one trouser, it may be 1000 rupees. If you buy the second one, you pay only 50%. So price of one depends on the price of the other. Second one is 50% discount provided you buy the first one. The goods or services promised in the contract or some goods services promised in each of the contract are a single performance obligation. You have taken a car with car services. It's a single performance commission. They will provide you the car. Now they will give you quarterly services for 2 years combined together. If you take separately, you need to pay higher price. But when you combine these two, you pay less because price of one will depend on the price of the other. Here 2 things that we need to remember. First thing you see, at or near the same time. This is the necessary condition. At or near the same time. This is the necessary condition. First thing we need to remember. Second is what? The amount and timing of revenue might differ. When you combine things, you pay less. Aggregate amount is less than the individual prices because you make a single payment for more than one contract. Second thing, timing may be different. You may pay one money at one time, that is for the car you make the payment. For the car services, you pay them gradually when the service is performed. If it is a quarterly maintenance service, you pay quarterly. So remember this, that the amount and timing of payment might differ. Now, there is other examples of, you see, combination of it can be mobile connection plus data usage. It can be Wi-Fi broadband. It can be DTH, TV connections. They are all combined. Goods and services. So they are treated as a single performance obligation because they are negotiated as a package and price of one depends on the price of the other. Next slide. Now we understand the combination of contract. Yes. On 1st June 2003, NTTA year end 31st March entered into a contract to construct a machine for CU 5000, which includes servicing for 1 year from the date of delivery. The construction commenced on 1st July 2003 and was completed on 30th September 2003 and was delivered to the customer. NTT estimates that servicing cost will be CU 400. a reasonable markup is 25%. Markup is the percentage of profit on cost. The customer paid CU 5,000 on 5th June 20x3. The costs were material 2,000, labor 1,000, allocated overhead 500. Okay, so it's a combination of contract. Two contracts taken as a single performance obligation. What are the two contracts? Selling of the machine. Second one is providing service to this machine. The transaction price of 5,000 is to be allocated between sale and servicing. The revenue that is to be allocated to the service is 500. 400 plus this markup. That means 25% of 400 is come to 500. In effect, revenue from machine is 4,500. Total is 5,000. 500 is allocated for the service. Revenue from servicing is recognized evenly over 1 year period because the service is also for 1 year. Next, for the reporting period 31st March, cash account debit to contract liability 5,000. Contract liability is contract liability becomes revenue for two things. 4,500 from the car because performance obligation is satisfied when the car is delivered. Sale of machine is delivered when it is sold, and half of 500 rupees because that is pertaining to this reporting period, 250 becomes my revenue. So machine revenue is your 4,500 and service revenue is 250. Total is 4,750. So revenue is 4,750. My cost of sales is 3,700. Accounting profit is 1,050. You see it is the accounting profit, and 250 is the contract liability that is deferred for next reporting period, which will become revenue when the entity provides service in the next reporting period.